Assalamualaikum and welcome everyone. This short discussion will be about impairment of CGU. For this presentation, I would like to give credit to BDO for its publications on IFRS in practice, IAS 36, Impairment of Asset 2020 and 2021. Grant Thornton for its publication on impairment of assets, a guide to applying IAS 36 in practice 2014, and ACCA Global article on impairment of goodwill and CGUs 2012. In this presentation, I will be discussing the challenges in doing impairment tests for CGU, goodwill, and corporate assets, but we will start with the overview and identifications of CGU first. For the overview, let us start with the basic. We know that impairment loss occurred when the recoverable amount is less than the carrying amount, and the recoverable amount shall be chosen from the higher of fair value minus cost to sell and the value in use. But as discussed in previous FAR course on impairment, it is not every time that we could come up with both values, and if that is the case, whichever one available will be used in the impairment testing. Now, recoverable amount is usually calculated at the individual asset level. Problem is, individual asset not always generate own cash. Therefore, to get to value in use that depends on cash flow, that is impossible. But individual asset like this usually is used together with other assets. It contributes to the generations of cash with a group of assets. So what we can do is to estimate the value in use of that group of assets. And that group of assets is what we call cash generating units, or CGU in short. Now from here, we could use the recoverable amounts of the CGU to assess if the individual asset in review is in fact impaired. The challenge though is to identify the smallest CGU that the individual asset in review belongs to. Not only that, the identifications of CGU is a way to estimate the impairments of non-cash generating individual assets. It may also be the other way around, because to test for impairments of a CGU, it needs to consider every single asset that has contributed to its cash flow. So it works both ways. The assets that will not able to generate cash on its own, or even to find their fair value, is goodwill. And a group of assets that face the same challenge is corporate assets. So these two assets are the focus of the discussion in testing for impairment of a CGU. And the standard in paragraph 80 requires CGU to include goodwill, and paragraph 102 requires CGU to include corporate assets in their assessment. Grant Thornton added another group of assets that they refer to as operational assets, but the concept of what it is and how it is assessed in relation to CGU is the same with individual asset, where its recoverable amount may be determined, thus assessed for impairment on its own, or if that is not possible, like goodwill and corporate assets, it needs to be tested together with a CGU that it belongs to. In MFRS 136, these are the paragraphs that are relevant to CGU, so for details, you might want to have a look at them. There are three keywords in the definitions of CGU: smallest identifiable group of assets, that can generate cash inflows, meaning it can generate its own income, and in generating the cash inflows, they do it on their own, not depending on other assets or group of assets. Paragraph 69 further emphasized that the cash inflows must come from external party and not internal party, simply means not within group. Paragraph 70 includes existence of active market for an output of group of asset as another factor to be considered, even if the output is internally used. Thus, the cash flow would be not at arm's length transaction. But the fact is, market for it exists, so it can be considered as a separate CGU. Only thing, the cash flows need some adjustment to get an estimation that is as close as it can be to the cash flow should it traded at arm's length transaction. Now, paragraph 72 requires that the CGU being identified on yearly basis in case there is a change in the structure, either resulted in combining more group of assets to become one CGU or splitting the previous CGU into several CGUs, and such changes must be disclosed. In this illustration that your colleague presented, the asset in review is the railway. This is quite obvious that it could not generate its own cash. Thus, to assess its impairment, we have to assess the CGU that it attached to, that is the mining activity. The scrap value cannot be considered as fair value since it will be valued as iron or steel or both, depending on what the railway is made of. The value will not be equivalent to a railway that is used by a mining activity. For the second example given, although they can and do generate cash flow individually and do not depend on each other, but the contract requires a minimum of all 5 routes under one contract. There is no way that the company can operate on those 5 routes without the same contract, let alone separately. Thus, the smaller CGU is considered the bus company as a whole. For the third example presented, the focus is on the active market of the output to determine the smallest group of assets that generate cash independently, thus CGU. For scenario 1, given the components from plant 1 has active market on its own, it simply means that even without plant 2 and plant 3, plant 1 can still generate its own cash flow, thus plant 1 is a separate CGU. However, the same cannot be said about plant 2 and plant 3 because they depend on components produced in plant 1 and have no control over the volume fulfilled by plant 1 for their market. So on their own, separately, they could not generate cash independently, but together they could be a CGU separate from plant 1. Remember that plant 1 product is different from plant 2 and plant 3, so they have different markets altogether. For scenario number 2, however, plant 1 cannot be considered as a separate CGU simply because there is no market for what it produces. Therefore, only when all those 3 plants considered together as one unit that they can generate cash flows. Thus, value in use for them can be estimated. Let us look at CGU with goodwill. To illustrate that, let's say we manufacture 2 different things. We manufacture motorcycle for local market and we manufacture special drones for Canadian market. Say for Canadian market, we decided to acquire 100% interest in a company called Drone Shop Canada to be the sole retailer for our drones in Canada. It has very good reputation as the center for drones, and by acquiring it, we could control the selling of other drones as well. There is no need for us to establish our own retail company, so no need to do too much marketing since Drone Shop Canada with their expertise and networking will do it for us. And people all over Canada are so familiar with the shop and perhaps trust the shop. The acquisitions of Drone Shop Canada has benefited the production line for drones, so accordingly, if the acquisition resulted in goodwill, according to paragraph 80 of the standard, for the purpose of testing for impairment, we need to allocate the goodwill that we acquired to that production line. No allocations of goodwill for the production line of motorcycle, so impairment for plant 1 as a separate CGU can be done without the goodwill. The standard also emphasized that if the CGU is disposed, the goodwill for which it benefited from must be included in the carrying amounts of the CGU to calculate the gain or loss on the disposal. You may refer paragraph 86 on this. Then you may ask, what about Drone Shop Canada itself? Is it not an entity that generates own cash flow, thus also a CGU? It depends on its function then. If, say for example, after acquiring Drone Shop Canada, the majority of drones come from only our plant 2 in Malaysia, then Drone Shop Canada will not be generating cash without our plant. Thus it becomes part of our plant 2 CGU for the purpose of impairment of plant 2. If there is no such arrangement, thus Drone Shop Canada, even without our drones, can generate own cash flow. Thus by itself is a separate CGU. But the goodwill will still need to be shared with plant 2, as plant 2 as a CGU need to consider all assets that contributes to its cash flow generation. And if Drone Shop Canada also become the sole retailer for our motorcycle in Canada, then we need to also allocate the goodwill acquired to plant 1 for motorcycle production line. In other words, these 2 separate CGUs are sharing the benefits of the acquisition, thus sharing the goodwill. So if that is the case, to test for the impairment of the CGUs, including goodwill, we need to calculate the recoverable amounts of all 3 CGUs with allocated goodwill in them and compare that with the carrying amounts of all 3 CGUs. But paragraph 88 also states that if for some reason, even with clear direct significance as shown between Plant 2 and Drone Shop Canada here, the goodwill is not allocated to Plant 2, then Plant 2 will be assessed for impairment when needed without the goodwill. For the allocations of goodwill, paragraph 80 also states that the CGU with allocated goodwill shall not be larger than operating segment before aggregation. You may refer to the discussion on MFRS 8 operating segment on the aggregation. And paragraph 90 states that if goodwill has been allocated to the unit, since intangible assets must be tested for impairment on annual basis, the goodwill allocated CGU must also be tested for impairment annually. To assess for impairment, we compare the carrying amounts of CGU with goodwill included with the recoverable amounts of the CGU. If recoverable amount is greater than the carrying amount, both CGU and goodwill are considered not impaired. If recoverable amount is lesser than the carrying amount, impairment loss must be recognized accordingly as per paragraph 104. Now please note that allocation of goodwill cannot be made on arbitrary basis, meaning allocation must be based on a systematic and reasonable basis and perhaps consistent. So if allocation to individual CGU with non-arbitrary basis is not possible, paragraph 81 states that the goodwill need to be assessed at the lowest level for all CGUs at which goodwill is monitored. Similarly, for the purpose of disposal, if allocation can be made to CGU, then it must be included in the carrying amount when calculating for gain or loss on disposal of CGU, as I mentioned in previous slide. If part of the CGU is disposed of, then the goodwill associated with that part should be measured on the basis of relative value of part disposed of and the part retained, unless there is other more systematic way of allocating the goodwill to the portion disposed of. To illustrate the guideline, let's say we have a CGU with allocated goodwill, and the goodwill allocated to the unit cannot be identified or associated with an asset group at a level lower than that unit. But we know in this case, goodwill must be included in the calculations of gain or loss on disposal, thus it must be included in the carrying amounts of the disposed portions of CGU. So when the entity sells an operation that is part of the CGU and say the portion disposed is sold at 100 million ringgit, which is the recoverable amounts for that portion disposed, and the recoverable amounts of the retained part of the CGU is at 300 million, the goodwill can be allocated to the disposed portion at 25%, the relative value between value of part disposed and value of the part retained. Another asset or group of assets that need to be considered when assessing impairment for CGU is corporate assets. An asset other than goodwill that also contribute to the generations of cash flows of CGU under review and other CGUs as defined by paragraph 6 of the standard. Now paragraph 100 stated that corporate assets include group or divisional assets such as the building of a headquarters or a divisions of the entity or a research center that do research and testing for the CGUs. For that matter, corporate assets do not generate cash inflows independently, thus recoverable amounts cannot be estimated unless disposed. And their carrying amount cannot be fully attributed to the CGU under review or to any one CGU since it contributes to all of them, unless of course there's only one CGU. So similar to goodwill, it works both ways for CGU and corporate assets. To test for impairment of CGU, we need to include all other assets that contribute to the unit's cash flow, thus it may include corporate assets. And if we determine that corporate assets may be impaired, the only way to test for their impairment is to determine the CGU or group of CGUs that these assets belong to. and compare the recoverable amounts of this big group of assets with their carrying amount. If their carrying amount as a group is greater than their recoverable amount, we need to recognize impairment loss in accordance with paragraph 104. Now please note that each CGU, like in this case plant 1 and plant 2, may be tested separately if we can allocate the carrying amounts of corporate assets to each CGU. In terms of allocating the corporate assets to CGU when testing for impairment, paragraph 102 gives some guidelines. If a portion of the carrying amounts of a corporate asset can be allocated on a reasonable and consistent basis to that unit, we compare carrying amounts of CGU including the portions of the carrying amount of the corporate asset allocated to the unit with the CGU's recoverable amount. If there is an impairment loss, we recognize in accordance with paragraph 104. The same can be done for plant 1 separately. Now, if a portion of the carrying amounts of a corporate asset cannot be allocated on reasonable and consistent basis to CGU, the entity shall do these 3 steps. First, compare the carrying amounts of the CGU without the corporate asset with its recoverable amount. If there is an impairment loss, recognize it in accordance with paragraph 104. Second, identify the smallest group of CGUs that includes the CGU under review and to which the carrying amounts of the corporate asset can be allocated. Say for example, we are testing impairment for plant 2, but corporate assets cannot be allocated to each CGU at a reasonable and consistent basis. So the smallest group of CGU will be both plant 1 and plant 2 together. And third, compare the carrying amounts of that group of CGUs with the recoverable amounts of the group of CGUs. If there is any impairment loss, recognize it in accordance with paragraph 104. This way, we are testing for possible impairment loss at all levels and hopefully not missing any significant impairment. Let's now talk about the test itself. We know that impairment loss is recognized whenever the carrying amount of an asset is greater than its recoverable amount. For CGU, as a group of assets, its carrying amount also need to be determined on a basis consistent with the way recoverable amounts of CGU is determined. According to paragraph 76, for the carrying amount, we shall include all assets directly attributable to CGU and assets that contribute to cash flow, thus indirectly related, such as goodwill and corporate assets. Liabilities should not be included at all, unless recoverable amount cannot be determined without considerations of the liability, like in the case where a buyer of an operation that is required to also assume the operation's liability. Therefore, carrying amounts of CGU is increased by the carrying amounts of those indirectly related assets and decreased by the carrying amounts of those liabilities. For timing of the test, paragraph 96 states that it may be performed at any time during an annual period, provided that the test is performed at the same time every year. Therefore, different CGU may be tested for impairment at different times. However, if some or all of the goodwill allocated to a CGU was acquired in a business combination during the current annual period, test for impairment before the end of the current annual period is required because of the newly allocated goodwill. Paragraph 97 further states that if an individual asset constituting the CGU to which goodwill has been allocated is tested for impairment at the same time as that CGU, it shall be tested for impairment first, before the CGU. Also, if an individual CGU constituting a group of CGUs to which goodwill has been allocated is tested for impairment at the same time as that group of CGUs, the individual CGU shall be tested for impairment first, before the group of CGUs. To recognize impairment loss for CGU with goodwill, corporate assets, and other directly related assets, paragraph 104 and 105 give us some guidelines. Since when testing for CGU, we also required to include all directly attributed assets as well as other assets that contribute to the cash flow of the CGU or group of CGUs, paragraph 104 requires that the impairment loss to be allocated to all of them in this order. First, it must be used to eliminate the carry amounts of goodwill. If there is still impairment loss remaining, then we allocate the remaining loss to other assets in the CGU or group of CGUs in review on a pro rata basis. When allocating impairment loss to assets other than goodwill, we need to watch out for the reduced value of their carry amount. As per paragraph 105, the carry amounts of these assets after deducting allocated impairment loss shall not reduce below or shall not be lower than the highest of its fair values minus cost to sell if measurable, its value in use if determinable, and zero. Whichever amount that we refer the recoverable amount as for each asset, it shall not be lower than that. So if, for example, the carry amounts of CGU2 with the allocated impairment loss reduced to lower than its recoverable amount, the excess amount should be allocated on pro rata basis to the other assets of the unit or group of units. Now, if, as a result of the impairment testing, there is no impairment loss for the CGU or group of CGUs, paragraph 107 states that no impairment loss shall be recognized even if the individual asset's fair value cost minus to sell is less than its carrying amount. So that is all about impairment loss on CGU, and I hope this short discussion has helped you to understand it a bit better. There will be a short video on illustration to add to your understanding. Until then, thank you very much for watching, and wassalamualaikum warahmatullahi wabarakatuh.